Welcome to the Deep Dive. You know the drill. We take your complex research and notes, and we extract the absolute core insight. Today we're tackling, well, one of the biggest names out there, a really polarizing deep dive into the financial health, the business model, and yeah, the sky-high valuation of Tesla Inc. You sent us quite a mountain of sources this time. We've got the latest Q3 2025 financials, competitive analysis, those crucial forward-looking DCF models. Our mission, as always, is to cut through all that noise. We need to figure out exactly what kind of future the market is betting on. I mean, what kind of growth is actually needed to justify this colossal stock price?
Yeah.
Is it a car company? Is it a tech giant? Or something else entirely?
It really is a phenomenal case study in growth investing, isn't it? But that ambition, it leads to massive volatility. You know, traditional metrics, they often just fall short here because the bulk of the potential earnings the stock seems to be pricing in, think full self-driving energy well, they're probably years away if they happen at scale. So to kind of anchor this discussion, maybe we should start with a tough conservative check. The Buffett checklist.
Ah, the value investing lens. Good idea.
Yeah, let's see how Tesla stacks up against a really disciplined value benchmark. Then we can dive into the more aggressive scenarios needed to make sense of its current valuation.
Okay, sounds like a plan. But before we unpack any numbers, just a necessary note. The analysis we're presenting is based strictly on publicly available sources. It's intended for educational purposes only. This discussion, it doesn't constitute investment advice. Please, always conduct your own due diligence before making any investment decisions. Right, disclaimer done. Okay, let's begin. Q3 2025 snapshot. What was the core financial tension? What really jumped out from the latest reports?
Well, what stood out immediately was this kind of conflict between volume and profit. The company reported record total revenue, which is great, hovering somewhere between, say, $23 and $25 billion for the quarter, mostly driven by record deliveries.
Okay, so lots of cars going out the door.
Exactly. But the cost of that volume was steep. Net profit declined significantly year on year. We're talking down maybe 40 to 50%.
Wow, that's a big drop. And that profit decline is basically all tied to the price war, correct?
Precisely. It's a direct consequence of those aggressive global price cuts on the Model 3 and Model Y. And the key strategic insight here is the trade-off you see in the margins. Automotive gross margin, so the profit on each car sold fell sharply down into the high teens.
High teens. That's a huge drop from where they were.
Oh, absolutely. Drastically down from the, roughly 25% average they were enjoying in the prior year.
And this is where management's long-term bet becomes crystal clear, right? They're choosing volume over immediate profit.
Exactly. Elon Musk has explicitly stated this. He's prioritizing volume, expanding the vehicle installed base, getting as many cars on the road as possible. He's sacrificing that near-term profitability, betting that this larger fleet will eventually, serve as a gigantic revenue pipeline for future high-margin software like FSD and other services down the line.
It's that classic Silicon Valley playbook, the land grab strategy.
Applied to hardware, yeah. But it definitely punishes the quarterly earnings right now.
Okay, speaking of that whole ecosystem.
Yeah.
Let's maybe detail the revenue streams. We know it's mainly an auto company today, but where does its competitive edge, its moat, actually lie? Especially if the margins on the cars themselves are, well, eroding.
Good question. Currently, the revenue picture is pretty clear. Automotive sales dominate. That's roughly 79% of the 2024 total revenue. Then you have services and energy generation and storage. They kind of split the rest, around 11% and 10% respectively.
And those regulatory credits, still a factor.
They are, yes. High margin, definitely, but pretty minimal in the grand scheme of things, maybe 2% of the overall picture. But the moat, yeah, it's really not just about selling cars anymore. Manufacturing expertise is, well, becoming more common across the industry. Tesla's real advantage is built on 4 core kind of integrated pillars.
Okay, let's break those down. Where do we start? Brand.
That's the first pillar. Brand and technology leadership. I mean, Tesla is still the aspirational name in EVs for many people, synonymous with cutting-edge tech. The second is pure execution, scale and efficiency. They're pushing towards, nearly 2 million units a year now?
Incredible scale.
It is. And their expertise in high-volume, vertically integrated production, especially making their own batteries and powertrains, it drives unit costs down faster than most competitors can manage right now.
But the real lock-in, the thing that creates that network effect, that's pillars 3 and 4, right? The stuff legacy automakers just don't have in the same way.
That's exactly right. Pillar 3 is vertical integration and charging. They design their own chips, their own software, which is significant. But The critical piece here is the proprietary global supercharger network.
Yes, the charging experience.
It's huge. Reliability and availability of charging is probably the single biggest factor in EV anxiety for consumers. For years, that proprietary network gave Tesla owners confidence they could actually road trip reliably.
Creating a powerful ecosystem advantage. And buyer loyalty, too, I imagine.
Definitely. And then the fourth pillar, which is arguably the most valuable, or at least the one with the biggest potential value, is data and software, FSD. Think about it. Over 5 million vehicles on the road, constantly collecting billions of miles of real-world driving data. That feeds its AI development for autonomous driving.
A data advantage no one else can really match at that scale.
Not currently, no. And crucially, that FSD software, it sells for up to, what, $15,000 per car now?
$15,000 for software.
Pure high-margin software revenue. And it's still a big if, but if it achieves true scalable autonomy, it completely transforms the business model.
Okay, that software potential clearly explains some of the premium valuation. But connecting this back to the bigger picture, the sources you looked at warn about significant pressures, competitive, structural. What are the major headwinds that could actually erode this powerful moat?
Yeah, there are definitely risks. On the short term, the pressures are mostly macroeconomic, I'd say. High interest rates are making all expensive purchases, including car loans, less attractive for consumers.
Right, hurts demand directly.
Exactly. And that forces those price cuts we talked about, which is why we saw the margin pain in Q3 2025. And alongside that, we are seeing truly intensifying competition.
Specifically from China, wasn't that mentioned?
Absolutely. It's not just the legacy automakers finally bringing compelling EVs to market. You've got rivals like BYD in China who are, well, often highly subsidized and competing very aggressively on price and volume.
So Tesla can't just raise prices back up easily.
Not without losing market share, no. It makes the price cuts feel more like a structural necessity now, not just a temporary choice. Then, looking longer term, the structural risks are maybe even more concerning. The first one is obvious: key man risk.
Elon Musk.
Tesla's reliance on him is just profound. His attention is constantly split across these massive demanding ventures, SpaceX, X, Twitter, and his, let's say, controversial public profile creates unique legal and reputational risks that could, frankly, impact the Tesla brand and its stock price almost instantly.
Is there a worry in the market that his focus on, Mars or achieving full autonomy distracts from the day-to-day grind of running a massive car company in a tough market?
I think that's the central tension, yes. Second major risk, market commoditization. What happens if the technology stabilizes? If everyone starts making great, affordable EVs, which is already happening to some extent,
then the cars become like gasoline cars today.
Potentially. And if that happens, Tesla's historical, 25–30% gross margins could permanently erode. It just becomes a low-margin product like any other car.
A tough reality for a company priced like a tech leader.
Indeed. And third, they absolutely must sustain their tech lead. What if a competitor, say Waymo, achieves regulatory approval for scalable, true level 4 autonomy first? Or if a battery rival develops a radically cheaper or significantly denser battery pack?
Then Tesla's core advantages could just vanish.
They could be significantly diminished, yes. They have to keep running faster than everyone else just to stay ahead. The innovation pressure is immense.
Okay, so despite those threats and the price wars, Tesla somehow still maintains better margins than most traditional automakers on their EVs. How? Let's touch on their efficiency. How are they managing this cost advantage?
They are masters of cost discipline in many ways, especially in managing their variable and operating expenses. Predictably, the largest variable cost is materials and components.
The battery, I assume.
The battery pack, yes. It's the single most expensive item in the car, costing roughly, let's say, $100 to $150 per kilowatt hour. That number is crucial. Their fixed costs are obviously massive too. Tens of billions invested in R&D, about $4.5 billion in 2024 alone. And of course, the depreciation of those huge gigafactories.
But they leverage those fixed costs better.
That's the key. They mitigate those factory costs by demanding extremely high volume and utilization. They spread those fixed costs over far more units than any competitor currently can with their EV programs.
And then there's the big one, the key differentiator that makes their operating margins look so much better compared to legacy auto, that famous lack of a traditional marketing budget.
Absolutely. This is, you could argue, structural genius. Tesla famously spends almost zero on paid advertising.
Zero, compared to billions for the others.
Billions annually, yes. TV spots, digital ads, sponsorships. Traditional automakers spend hundreds, sometimes thousands of dollars per car sold just on marketing. Tesla basically substitutes that massive direct ad expense with brand buzz, media attention, and, well, Musk's immense social media presence.
Which saves them a fortune.
A fortune. That structural difference dramatically lowers their operating costs relative to peers, and it's a huge component of why their margins have historically been superior.
Okay, this raises the critical question then. We've established they're operationally excellent, they have a strong moat, despite the risks. But if we apply that litmus test of Warren Buffett, the ultimate value standard, how does the world's most valuable automaker actually stack up?
The Buffett checklist. Well, the results based on the standard checklist metrics are pretty definitive. It's a clear fail on valuation discipline. It's not even close, really.
Okay, give us the numbers.
Buffett typically looks for a price to earnings, or PE ratio, of less than 15. Tesla's PE was around 181x in 2024.
181 versus 15.
Okay, right. Then PB ratio, price to book value. Buffett wants that under 1.5. Tesla's PB was nearly 19x. Again, orders of magnitude different.
Those numbers just scream growth stock, not value stock.
Yeah.
Completely decoupled from current intrinsic value based on earnings. And it fails the earnings consistency test too, right?
It does. Buffett likes to see positive, ideally rising earnings per share every single year for a decade. That signals stability and predictability. Tesla only became consistently profitable after 2020. And because of the recent price cuts we discussed, we actually saw EPS decline from 2022 to 2023. So yeah, it fails the consistency and predictability measure required by strict value investors.
So given that pretty definitive failure on the value front, is there any part of the company, financially speaking, that would actually appeal to a conservative investor like Buffett?
Ironically, yes. There is one area where it passes with flying colors: balance sheet safety.
Really? Tell me more.
Tesla has completely transformed its balance sheet over the last few years. It's now a financial fortress. Its current debt-to-equity ratio is extremely low, around 0.19 now.
Very little debt relative to its equity.
Exactly. And its interest coverage, basically how easily it can pay the interest on its debt from its operating income, is excellent. It was around 20x in 2024. So the company itself is built on a very stable, low-debt foundation. That financial conservatism would absolutely please someone like Buffett.
Okay, so the company is financially stable, solid foundation, but the stock price is clearly priced purely on future growth. Since the value isn't reflected in current earnings, it must be projecting something way out there. We ran a discounted cash flow, a DCF analysis, to try and see exactly what kind of future growth is currently baked into that stock price, which is sitting around, what, $250 per share as we record this?
Yep, around $250. And this, I think, is the real moment of truth for understanding the valuation. We used a standard 10% discount rate, just for consistency across the scenarios. Okay, first, our conservative case. This assumes free cash flow basically stagnates around current levels, maybe due to heavy competition and margin pressure continuing.
Okay, what's the value there?
That scenario yields an intrinsic value of only about $28 per share.
$28. Wow. That's a staggering potential downside if the big growth story just stops or significantly slows down.
It really underscores the risk, doesn't it? It's sort of the minimum price if they just become another, albeit efficient, automaker. Then our nominal or base case. This assumes pretty robust continued expansion. Let's say free cash flow increases 20% annually for the next 5 years, then tapers off.
Still strong growth, 20% a year. What value does that give?
That yielded an intrinsic value of around $81 per share.
81. Okay, so even with strong, sustained growth, the current price of $250 is still way, way above that.
Untouchable by those traditional metrics, even with solid growth baked in, which brings us to the final scenario. To even get close to the current market price of $250, we had to run the optimistic case. This assumed free cash flow would increase by an incredible 40% annually for 5 years straight.
40% growth per year for 5 years. That's extremely bullish.
Extremely bullish. And even that scenario yielded an intrinsic value of only around $225 per share, still slightly below the current market price.
So the market isn't just pricing in success or even robust success. It's pricing in an extraordinary, almost best-case scenario outcome.
That is the inescapable conclusion. The market's current valuation around $250 implies that Tesla must execute something close to this extreme optimistic scenario. It means Tesla's annual free cash flow needs to multiply roughly tenfold over the next decade. It needs to reach cash flow levels comparable to, say, Apple's free cash flow today, and then sustain strong terminal growth after that.
Which leaves almost no margin of safety, as value investors would say.
Precisely. At current prices, there seems to be almost no room for error, no margin of safety if even small operational hiccups occur, or if FSD takes longer or competition proves tougher than expected.
So wrapping this up, What really stands out is this incredible high-stakes gamble baked into the stock. Tesla is balancing this aggressive market share expansion, taking the margin pain today, while relying entirely on achieving these futuristic high-margin successes in autonomy and energy storage to justify this extraordinary valuation. It's clearly a fundamentally strong business in many ways, great brand, strong balance sheet now, but by no classic measure could you call it a value stock.
I think that's fair. And the ultimate insight, maybe, is that the massive gap between, say, our $81 per share base case value and the current $250 market price, that difference is the market's absolute expectation. It represents the bet on Elon Musk's non-auto ventures eventually adding huge value and the almost certain belief that FSD will successfully monetize on a massive scale. If that core bet fails, well, the downside could be significant and maybe quite immediate.
And that brings us to a final thought. The source material we reviewed noted how Tesla's unique structure relies so heavily on that Musk-centric model for radical innovation. Will this aggressive pursuit of huge long-term goals, like achieving full FSD or colonizing Mars, even eventually clash with the more mundane, fundamental need for better governance, deeper management structure as the company matures into potentially a trillion-dollar entity? What happens when the CEO's attention is constantly pulled toward other highly demanding ventures that might pull capital, energy, and focus away from the core automotive and energy businesses? That really feels like the high-stakes gamble built into every share price today, something definitely worth thinking about. Now, if you are interested in tracking things like total market temperature using frameworks similar to what we discussed, like the Buffett Indicator, you can actually search and download the iOS app called Buffett Indicator right from the Apple App Store.
It's a neat tool for context, and we really appreciate you joining us for this deep dive today. It was a complex one.
It certainly was. Okay, one last time. This content is based on publicly available sources, it is for educational purposes only, and it does not constitute investment advice. Please always conduct your own due diligence before making any investment decisions. And if you want to hear more deep dives like this one, you can find our full archive by subscribing to us on Apple and Spotify podcasts. Just search for Deep Value Investing. Thanks for listening.